We have a couple of risks. So the biggest one is, of course, the trade tension between the United States and China. In case these trade tensions will increase, that will have a very negative impact on the global economy. We are a small open economy, exporting a lot, importing a lot, so we depend on the possibility of exporting, and everything that is negatively influencing the global economy is bad for us. So this is the most or the biggest risk for us. The second one is, of course, the European situation. We have their Brexit, but we have also the Italian fiscal situation. All those risks may have a negative impact on the European situation, on the European growth, and that would also be negative for us.
But what's interesting is from March to now, you haven't actually changed your forecast from 1.5%, even though you could argue that some of the risks to the downside when it comes to the trade war and tariffs have intensified. So why have you kept it unchanged?
Well, we believe that the base scenario remains intact. And this is in line also with the IMF and other international organizations, many other central banks. What is a little bit different is really the view about the risks. And we see more risks to the downside and bigger risks than 3 or 6 months ago.
And that's why today you said that expansion in monetary policy is still necessary. You've got two main tools in your toolkit. You've got negative interest rates at minus 75 basis points, and then you've also got the possibility of using FX interventions. If the situation deteriorated further, would you lean more towards one or the other in terms of what policy you want to use?
Well, I cannot be very specific on your question here, but what is clear is that we have room of maneuver in both of these instruments with the interest rate, the negative interest rate. We can go further down there, but we have also room with extension of the balance sheet and, of course, with intervening then in the foreign exchange market.
But you're already at minus 75 basis points. That's the lowest interest rate out of the whole world. And yet you're saying that you have more room to the downside. Is that because you think that your tiering mechanism is successful? Are you not worried about some of the side effects insofar as it pertains to the real estate market, the banking system? No.
Well, so far they work very well as intended, and we see really no problem in implementing those negative interest rates. Of course, the global environment with very low interest rates have impact on financial stability issues. We have to take them into consideration. But the main focus here is on monetary policy, and there we believe that we can still use this instrument further. And the other one is, of course, the balance sheet, where we have also room to expand it and in order to make interventions if necessary. This is important in the foreign exchange market.
Another question on interest rates. There's been speculation now in the market that the European Central Bank, the ECB, may have to start thinking about either cutting rates further or reintroducing quantitative easing. How closely are you watching what the ECB are doing?
Well, the international environment for us is very important. So we have the interest rate differential, we have general economic conditions, conditions in the financial markets. So we are watching the global economy very closely, and of course, specifically also the European situation very closely, because the Eurozone, the European Union, is the most important trading partner for us. So the conditions there have a big influence on demand for our exports and, of course, also on the general financial conditions.